The European Central Bank has hiked interest rates by 50 basis points, just as Credit Suisse's bailout news gave markets a tentative respite. Now, the ECB president, Christine Lagarde, had been widely signaling a 50 basis points hike, but markets bet had waned this week following the collapse of 3 American banks. That decision makes it clear the central bank decided to focus on elevated inflation, which is its mandate, and for now the ECB has overlooked any financial stability risks from the troubles in the banking sector. After the turmoil this week, markets had expected the ECB to walk a tightrope, but the central bank, facing an unenviable choice, stuck to its big rate hike plan. That dented sentiment, with Wall Street stocks opening lower. Early in the day, Credit Suisse borrowed nearly $54 billion from Switzerland's central bank on Thursday to bolster its liquidity and restore investor confidence. That helped Credit Suisse shares rise about 20% after the announcement, which came in the middle of the night in Zurich. On Wednesday, the Swiss bank's share price plunged, and it heightened concerns of a global banking crisis. But a rebound in Europe's battered banking shares was beginning to wane on Thursday as the ECB hiked rates. The European banking stocks were already seesawing after the market opened on Thursday, following a 30% plunge in the previous session. Europe's financial stocks had suffered their steepest one-day drop in more than a year on Wednesday. After initially rising post the bailout news, the European banking index was trading nearly flat. Global markets, though, had reacted more positively and cheered the bailout news. That comes after days of heavy losses due to investor concerns about potential bank stresses across the globe. The $54 billion lifeline makes Credit Suisse the first major global bank to receive an emergency bailout from central banks since the 2008 financial crisis. The troubles of the 167-year-old Swiss bank have raised serious doubts about the ability of central banks to sustain aggressive interest rate hikes. Global policymakers, though, have emphasized that things are different now compared to the 2008 financial meltdown. They claim that back then the world's banking system nearly collapsed due to a lack of capital. For now, Credit Suisse's troubles have not led to a full-blown banking crisis. A separate report showed the Swiss cabinet would hold an emergency meeting on Thursday to discuss the situation at Credit Suisse. While broadly some calm was restored in the markets, the global banking sector is still not out of the woods completely. That skepticism remains despite policymakers' assurances from Australia to Japan to Europe and the United States. What will not help is the ECB's decision to firefight inflation, even as markets debate whether the current banking crisis is a result of aggressive jumbo-sized rate hikes by global central banks.